So now it is my pleasure to invite the colleagues and invitees that will participate in the policy session that we will have right now. Ambassador. So this policy session goes back to the question of supporting least developed countries, and the policy roundtable is about fostering private investment in infrastructure in LDCs. This session is going to be moderated by Mr. Roland Mollerus, who is the chief of the Secretariat of the UN Committee for Development Policy in DESA. And I have the pleasure to have here in the room His Excellency Claver Gatete, the ambassador and permanent representative of Rwanda to the United Nations, and Ms. Liz Bronder, who is part of the Global Investors for Sustainable Development Alliance of the Secretary General, and the MD of Global Sustainable Finance in Bank of America. Roland, please, you can take the floor to moderate and present the colleagues that are online.
Thank you. Thank you very much, and good morning, Chair, to you. Just as a matter of interest, do we have a full hour, or are we supposed to finish this and wrap up by noon? Just so we know how to plan the session.
We have the full hour.
Okay, wonderful. Thank you so much, and good morning to everybody. Excellencies, distinguished guests, ladies and gentlemen, thank you so much for joining us virtually and or in person from the Trusteeship Council chamber. We will discuss, as was just mentioned, ways in which the LDCs can attract more private capital towards investment in sustainable infrastructure. During this session, representatives from both governments, the international development community, and the private sector will bring their expertise and insights to find actionable recommendations. For me, as the secretary of the CDP, as was just mentioned, the Committee for Development Policy, it's an honor to be here, and also a topic of great interest, because for those of you who haven't heard of this committee, it is an entity within the UN known for being responsible to identify which countries can be included and which countries can be graduated from the LDC category. I thank the chair for introducing the four speakers that we have with us today, and welcome those four speakers with us. And for the sake of time, I will not introduce them again. I think that was done very well just now. But quickly move on to the three blocks of activities that we have. And in the first block, I will ask some questions about the roadblocks that the various experts see ahead of the LDCs in terms of infrastructure financing. And then in block two, we will look at the solutions, and then end with a block three with questions and answers from the participants, and hopefully have a lively discussion. And with that, I would like to turn to Ambassador Gatete and ask each of the panelists to put on their screen and present to us the main challenges in bringing private capital to LDCs. For this block of discussion, we have 10 minutes allocated. So in your deliberations, please be brief. And there, to start with the ambassador, what do you see are the main challenges that LDC governments face in attracting private capital? Ambassador, the floor is yours.
Yeah, thank you very much. Sorry, I've been in so many presentations this morning, and I hadn't prepared anything really. But the way I see it is almost similar to the meeting that we had some few days ago. And from government, there are many, many challenges that usually we face. One is on the resource side, but also on the government preparedness. Sometimes what we have seen in the case of Rwanda is the framework that would be in place to really attract the private investors. Just to give you an idea, is that we need a lot of money in a country from all corners. But at the same time, we need long-term resources. And with those long-term resources, it's not just the banking system that you know of. I'll just give you an example that for almost 20 years in Rwanda, we had a problem where almost all the banking system were deposit-taking financial institutions. And sometimes you do find that about 70 to 75%, at least when I was the governor of the bank, you could find that this is the money that you put in the bank and you keep withdrawing. By the end of the month, the money is withdrawn, meaning that the banks cannot lend for long term. And at the same time, because they have a limited amount of money to lend out, the cost is very high. So when you start with domestic investors, private sector, it's very difficult for them to really break even and make profit, and that is the biggest incentive. And at the same time, in some of the developing countries, one thing that is not usually talked about is that a big chunk of the money is out of the banking system. Like you don't have the banking system that cuts across in the rural areas everywhere. And the banking system is what brings all the resources together so that we can lend out to the private sector. So we have that kind of problem, and that's why their monetary policy models are different sometimes from developed countries. Anybody here puts the money in the bank. None of you keeps the money at home. And in most cases, use the cards to make sure that you do the transactions. In some countries which are developing, they don't have that kind of flexibility. They have to take cash, and sometimes cash becomes a show that you are really above the average by carrying more cash. But that cash which is outside the banking system is not the cash that is benefiting the private sector in terms of investment because it's outside the banking system. Nobody's going to go and borrow and be able to do that. So we have that kind of constraints. And to do that, what we've seen is that in terms of, at least in the case of Rwanda, we had to address this kind of problem. And by the way, you find that some of these countries are not rated. The rating, the sovereign rating for a country is low. The banks, which are domestic, are not rated, meaning they cannot borrow in international markets because the cost will be very high, the risk will be very high. So with that challenge, in the case of Rwanda, what we had to do were several things. Number one is to see how to mobilize the long-term resources. And to mobilize the long-term resources, one of the things that we did first was how do we create the capacity that even can manage whatever resources you have. We found that for the money for the pension, because it has to be safe, we wanted AAA rating institutions to manage it. And all of them are found outside our country. It is these first-class institutions, banking system that are AAA rated. It's the World Bank. It's so many others, but which are outside. So even the retro money that we have is not going into our system to invest. It's going outside because it has to be well managed. The reserves of the central bank have to be managed outside. The sovereign wealth funds have to be managed outside. So you find that even what you have as a country is also going outside. Now, what is left in the country is very little money to invest. And that became like a challenge. So we had to build the capacity to make sure that we bring in the experts that can be able to manage that money inside the country. That was very, very important. Secondly, we had to make sure that, because we want to make sure that the resources are also coming from ordinary people and other investors who are not really into business of establishing a company and other things. So establishing for us a stock exchange was something very important, where you are trading in terms of stocks, in terms of bonds, and public and corporate bonds. So you find that that one is raising money from everyone, in the country, in the region, and outside the region. And that became also very important because this time, this is long-term resources. It's not the money you put in the bank, and tomorrow you go and withdraw. No, it's long-term resources. You can only share. You can only sell your stocks to someone else. But this is the long-term resources which actually we didn't have before. And now we are expanding, of course, so many products on the stock exchange, including derivatives, so that people would have different options in terms of investing their own money. And we've been doing a lot of training countrywide, starting from the university students to the general public, why it is important, and also the private sector, how to list, how to be assisted. And that included also the SMEs to make sure that they can also benefit from that. So establishing the stock exchange for us was very important. The race is now how do we expand it, and how do we link it to the region. And what I was telling my colleagues last time when you had almost a similar presentation, we had to say in the region, because we are small, you find that most of the investors are regional companies. But we needed something beyond the East African community in our region. So what we did was to agree that we should link our stock exchanges, the one in Rwanda, the one in Kenya, Tanzania, and at least Rwanda, Uganda, Kenya, and Tanzania, to link all the stock exchanges, and then Burundi will join at some point in the future. So once we did that, we approached the World Bank, who agreed to put on a platform, a trading platform. And that trading platform would allow us to be able to trade with each other. And because we are interlinked, then outside investors from Europe, from Asia, from America, from everywhere, can be able now to invest with confidence that there is a variety of products which you can invest in. And that one is being done because at least the platform is now completed. You are now working on the modalities. So the stock exchange now became very, very, very important. The other is really how to strengthen our institutional investment. The sovereign wealth fund, the pension. Sovereign wealth fund, we didn't have one. We had to establish it, and we had problems. I remember that by then I was the governor of the central bank, and it was so difficult because we are using reserves to intervene in the market. And there is a problem that really is affecting the developing countries. Usually, most of the money that comes in is either external loan or it's external grant. This money, when it comes to the central bank will retain the hard currency and provide the local currency. Now, that's the money they use to do the interventions in the market for the country to do the imports that they want, because they use foreign currency. Now, when those resources stop, it means actually you don't have a lifeline. It means you have very little resources left for you to be able to intervene on the market. And that results in a quick devaluation of your currency. And the quick devaluation has different implications, meaning the cost of living goes up, meaning that actually it becomes very expensive for anybody to be able to import, to invest. For example, for the capital investment, every country needs to buy the capital, at least materials from outside. If you are constructing a road, if you are doing quick investment where you have to buy products outside, you use foreign currency. So that one becomes very important. The other one, what we thought that would be very important is the pension, the insurance, the saving investments. Those ones, of course, for us has been very, very important. What we also did was the development bank, which we had to reinforce and link it with all the DFIs, especially in Europe. There are so many that actually provided the resources to make sure that we can have enough for long-term resources. But also on the investment side, and here I'm rushing because I'm under pressure that I'm taking more time. I thought I would give you the stories that would benefit for you, but at the same time, I have to finish. Is we have on the investment side, we are putting incentives in place to make sure that actually the investors can be able to do the investment. And that one is contained in our investment code. But at the same time, what has been helpful is for us to do the PPPs, is for us to prepare ahead of time so that the projects you have done the feasibility studies, and people who come, now they don't have to do their own feasibility studies. We have to do a lot of de-risking, and of course, we do a lot of bond issuance, especially for infrastructure financing, and also we do the pre-financing arrangement whereby actually the investment done ahead of time will allow us to collect more taxes and be able to pay back the money, but when actually we have received the services. So there are many things that I could talk about, but because of time, I think this is enough for any questions that may be asked. I can go into details for that. Thank you so much.
Thank you so much, Ambassador. That was very interesting, and it was clear to me that you come with a breadth of knowledge from your previous role also as Minister of Finance. And I think we're very lucky to have you with us today and to learn from all that experience, including the roadblocks you mentioned on access to financing and the cost of financing, and already going also at times into possible solutions. So very much appreciated, Ambassador. Thank you. And now I would like to turn to the next two speakers who were not yet introduced. They are joining us virtually. We will first have Mr. Marco Serena and then Mr. Jafer Machano. Mr. Serena is Head of Sustainable Development Impact of the Private Infrastructure Development Group. And we will ask Mr. Serena the question, what are the most significant risks that you assess to decide investing in LDCs and other frontier markets? The floor is yours, Mr. Serena.
Thank you, and thank you for inviting me today to share some of the experience of the Private Infrastructure Development Group as an investor. We are an infrastructure developer and investor. We deploy both public capital and private capital, and we do that across the infrastructure development cycle. So from project development to guarantees to debt and long-term debt. And I want to thank the ambassador for his remarks, because a lot of the things that that he said and that the government of Rwanda has put in place really resonate with us as investors. So 50% of all our investments are in least developed countries, and Rwanda is one where we did finance very significant pieces of infrastructure from on the debt side, from the water utility and the bulk water supply in Kigali to some of the pioneering projects on getting electricity from the energy on Lake Kivu. And I think the key things to assess there really depend on the stage of the project. And a couple of key things were mentioned there. So a project development stage, and we do equity investment into project going in at a very early stage. There's very little capital that wants to do that. It's really difficult. I think in terms of that, we would really look at how strategic the project is for the government, how strategic it is for the local economy and for the regional economy as well. And that gives us a guarantee that we're going to be in there for long term as an infrastructure investor, but we're doing that, mitigating the risk, because no matter what will happen with the political circumstances, there is a very, very strong economic sense and support for that investment. The other key things that we will be looking at is obviously how the feasibility and the work that has been done. And we've got the luxury of going quite early stage and contributing to some of that feasibility. But obviously, if the project is already a bit advanced in terms of the studies, permissions, licensing, that accelerates significantly the work for us as an investor. The key risks we are looking at as an infrastructure investor are, of course, the risks as who are the buyers of the services of the infrastructure that we put in place, and that is where the clear structures within the government and within the country, in terms of some of the things that have been mentioned already. So in terms of the possibility of obviously we'll be looking at the credit of the country, at the ratings, and that's where some of the challenges are, which I just wanted to touch for in a minute. And the key things are obviously the possibility to have very long-term contracts, and the credibility of the off-takers. So I think the work that governments are putting in and the countries are putting into, for example, the structuring and strengthening the energy utilities is something that will go a long way to attract more investment. What we've been doing in countries like Malawi is bringing projects, some of the first independent power producer projects to operation to a point where we can partially exit, and others will see that that the bill is paid effectively. So we need to demonstrate that. It is important for investors to see that there is success, and that will breed for the success. I think a key thing with the ratings is the difficulty in matching very high risk with pricing, where effectively you've got pricing capped in a lot of circumstances for affordability reasons, and that is where there is a need in some cases for some kind of blended finance solutions in order to make the interest of the different parties stack up. One of the things that we've really focused on is unlocking domestic capital from local banks, and including through tools like liquidity extension guarantees. This is I can bring an example of one of the power stations that we financed in Togo, and one of the problems was that bank could only come in for 7 years because of the credit profile of the and what we've been doing is provide a liquidity extension guarantee, effectively guaranteeing year 8 to 15, and that would allow us to structure the transaction in a way that that brings really the cost of finance in line with the needs for long-term projects like infrastructure projects. I think most importantly for an investor is the capacity, is the opportunity to have a dialogue with the regulators, with the government, with the counterparts, and with the local banking system and sponsors. I think that's a very, very important point for investors to build. What we're seeing at the moment is some of the big projects slowing down in many countries because of fiscal pressure and because of slowdowns and increasing costs, but also difficulty from governments to commit long term. And I think that is something which the international system should really look at because that will in turn slow down some of these big projects which have a very big impact in bringing down cost of production and improving quality of living and access for a lot of the people there. So these are the main items that I wanted to touch upon, and I'll just to summarize, I'll go back to the two key points really of the development of the projects and then the capacity to work with local financiers in a way that also de-risks investors that are coming from outside. And again, we've got very good examples of that.
Thank you. No, thank you very much. And exactly what you just said, the examples were very good to hear for me, and the synergies also with previous speakers, the ambassador on Rwanda and the earlier session on Malawi and the other country examples you mentioned. That was very, very good, very useful. You mentioned the importance of having long-term commitments, the risk factors, the importance of ratings, guarantees, and the unfortunate topic that there's a slowdown going on. And I think that's a very interesting observation there as well, and interesting to talk about further on, later on, maybe today. So thank you very much, Mr. Serena. I would now like to turn to our UN CDF colleague, Mr. Machano. Mr. Jaffer Machano is the Global Program Manager of the Municipal Investment Finance entity within the United Nations Capital Development Fund. Mr. Machano, I would like to ask you to talk a bit about the gap that the UN, CDF, and other institutions from the development community need to bridge to facilitate the flow of private capital? Over to you.
Thank you, Roland. First, I want to take the opportunity to say thank you for the acceptance and for being invited to this panel. And I agree that the setting up that the ambassador has done, it is a really resonates with the discussion of investment, as Marco has said, but even the idea of bridging up the gap, because he defined the gap. And the gap mainly comes from the lower duration of the deposits, meaning the deposits are not long enough to provide ability to lend long for infrastructure, and the informality of the economy. There's a lot more money in a lot of these LDCs that is not in the banking system, and that's normal according to a level of development. So what we do and support is we always start with reform policy, especially being a UN entity. And we look at 3 main areas. One is the capital markets, and we have programs to support stock exchanges, because I agree they're paramount into allowing long-term funding to go to infrastructure, because it's hard to build infrastructure with 3-year money or 5-year money, which a lot of these LDCs banking systems have. And the second part is for the government systems to be reformed so that this capital, when it comes in, it allows some sort of a cushioning in local currency. And this topic is whether we talk about rating or ability to manage pension fund, which comes with a fiduciary duty because they have to be very high quality. Our opinion is definitely there's a need of either blending financing to create a fast loss mechanism that will allow to absorb losses from funds that are not pension funds, either donor or government or guarantee. And the second one is guarantee products that allow different specific infrastructure projects to be issued in the market and to crowd in the private funds. So for example, we are currently doing a water utility bond. And here I will talk mostly about local governments and municipalities, because that's our main focus. And we are looking to raise $23 million in a secondary city in Tanzania for an expansion rehabilitation of bulk water infrastructure, billing system, and distribution. And before we are like a few months away from issuing, we are doing investment sounding with investors, and we have an understanding this bond will be already oversubscribed because there's enough capital in the market. And this is a local currency bond. So we are talking again about pension funds and insurance funds and savings, SACCOs and those kind of investors, that it will be subscribed fully from the local investors. So there's room to actually support the local economy to bridge the gap that allows local infrastructure to be built in the local market. In the interest of time, I'll stop here. There's a lot to be covered. We've created a fund in Paris together with Meridian that does this from the equity side. We are finalizing a really nice guarantee structure with the support of EU EFSD Plus program that will cover African cities. It's about $250 million. So there's a lot that products that can go to the market to bridge the gap and bring in capital that we can discuss later on. Thank you, Roland.
Thank you very much, Jafer, and very interesting also there talking about blended financing and touching on issues that that we will surely come back to in the solutions block, if I may call it like that. And with that, without any further ado, I would like to introduce Ms. Liz Bronder, who's the Managing Director of the Global Sustainable Finance in the Bank of America. with us in the room, as I understand it. To Ms. Bronder, I would like to ask what she sees as the main deterrents for private investors to go into a new frontier market. The floor is yours.
Thank you so much, Roland, and it's a pleasure to be here with all of you in person, and thanks to the ambassador for his initial comments, which I think laid out a number of the challenges that developing countries face. And I think first I'd like to just start with looking at the spectrum of financing and building a little bit on the Partnership Development Group, Infrastructure Development Group's thoughts on staging of projects, because there, in this spectrum of projects, there's domestic financing, of course, which is critically important, but many of these smaller countries, as we've heard, face challenges in mobilizing enough of their own domestic resources. But in the international community, there is everything from donor funding and grants, which come in on the development stages, through to equity, which is very important in initial stages, funds, special purpose funds that can invest in these types of projects as they're developing, and the smaller projects in particular, all the way to senior debt, which is mainly a product of larger regulated financial institutions like Bank of America, and then on to capital markets. And so there is also this progression through the stages of project financing, through the stages of what is available from different capital providers. And we have been making a concerted effort. I mean, Bank of America is very active in the capital markets, of course, and we've been trying to see how we can support smaller countries with our own balance sheet, where institutional investors cannot necessarily come in. And so we have developed a new set of criteria for ourselves in terms of a development finance framework, as well as looking at smaller projects that we can do on a project finance basis. And some of the challenges have been well laid out in terms of and the risks of what banks are looking for, which is really boils down to the quality of the revenue stream that can be generated to repay that debt. And so those are the types of risks that are heavily assessed, and where we're trying to see how we can bring in mitigating partners to be able to provide financing on a cost-effective basis. Because this is also a question that's really critical for the financing is the pricing. In the commercial markets, the risks are high, and so the pricing is high, and that is not necessarily a cost that's easy to bear for governments, and also for projects when tariffs are regulated in infrastructure and in energy. So partnering with institutions like development finance institutions that can help to bring down the cost of funding is actually very important for the financeability and the affordability of these types of financings. I think the other factors in terms of government policy is also important in the frameworks that you mentioned, Ambassador, where the private sector is now more actively involved in providing recommendations for what needs to be put in place to be able to accommodate strong contracts, for example, the ability to have offtake agreements, and the ability to have the types of controls that are required in order for long-term financing to be comfortable, I would say, to stay in markets for longer term. And so banks are getting more actively involved in these policy recommendations through organizations like GFANZ. We've been very active on some of for example, the the Just Energy Transition Partnerships, where there are certain countries that are trying to transition from fossil fuels to more renewable energy sources, and the frameworks that are needed for that to take place do require government action, and so these are some of the recommendations that the groups are making. And so as we've been looking at some of these smaller countries and small island states in particular, where there is the need for energy assurance and energy access, we have been able to find projects that we can finance on our own balance sheet in these markets, and it's a new area, and it is blended finance to build off that point, where we're partnering with development finance institutions. So we've just closed a transaction in the Dominican Republic with an energy provider that is going to be, in addition to putting in new renewable energy sources, providing access to energy in an island off the main island where no energy exists at the moment, and so and bringing that in to allow the fishermen and the other small businesses that are there to operate with electricity, which is just a big game changer in that respect. And we're also looking at trying to work. Knowing that governments, can also take some time to develop these new policies, trying to work with private companies that can provide those assurances themselves. So it becomes a purely private sector project in the sense that, we're working with this was another announcement we made at COP just a few weeks ago, working with a energy provider for commercial and industrial renewable energy sources throughout Africa in different countries, but relying on the offtake agreements of private companies that are operating in those markets. So even without the full spectrum of reforms being in place by each of the countries, there is still the possibility to bring private financing into these countries to be able to provide additional infrastructure and energy by having the arrangements be with other private companies that have revenue streams and their own credit ratings. So I think that these are some of the
Bronder,
mitigating factors.
Please wrap up if you can.
Thank you.
Thank you. I didn't want to interrupt you abruptly. I want to give you one more minute to wrap up. I hope you don't mind.
No, it's fine. I think that we're moving on to solutions, and I think we all tend to want to talk about the solutions as well.
Yes.
Yeah.
No, thank you very much. Very interesting. I liked also your reference to the smaller countries, including LDCs and the small island development economies. Your reference to the various stages, starting with donor funding up to the capital markets. I think that was very useful. And as before you went into the solutions, you mentioned also, as the other speakers did, the risks and the challenges, and you spoke to that. And I thought it was very useful to listen to you about the private sector recommendations. So thank you very much for that. And you were very right. It's very important not only to talk about the roadblocks and the problems, but how are we going to find solutions and work together with these countries to make things happen. And I think in the next maybe 10, 15 minutes, and I hope the participants don't mind that we go a little bit beyond noon. But I wanted to start by going back to the ambassador by asking the first question on solutions, what governments can do to reduce the gap between the perceived risk and the actual risk. Ambassador, the floor is yours.
Yeah, thank you very much. And if you allow, I can even respond to especially what our colleagues have just mentioned. Now, let me just very quickly go through it. One, for these big projects, usually require long-term financing for many years. And for that, if you don't have a feasibility study, then that one delays because nobody's going to come and first do the feasibility study and then decide whether they should make an investment. That's one. Number two, de-risking. Sometimes they need guarantees, sometimes they need other things that can make sure that the risk is reduced to the minimum. It has to be clear very much what government does, where you are going to get, for example, any kind of guarantees that are requested for you to raise money from the international financial markets. Third, one thing that is very clear that we have seen many times, especially on energy and other things, is am I going to generate revenues in local currency? And if I go to change them to foreign currency, how much is it? So for us, what we have done in Rwanda is guaranteeing that actually the contract should be in US dollars or in other currencies, that is hard currency, and then the forex risk will be taken by the country. So in other words, they pay you the money that is equivalent to the US dollar or to another pounds or whatever the currency is. So that one is what they fear most, and we have seen it. I can give you so many examples, just I don't have time. The other thing that we have seen is where do I get the long-term resources, but also that they are cheap, because you are putting in your stake for a long term. And that's where the structuring also, there has to be a way of working with the government and others, because it's a joint project, so that we can raise cheap resources because you are going in for a long term, a long haul. The other one is the PPP. Is government willing to go in with you? And if they are willing to go in with you, how? And then structuring that deal also becomes very important. The other thing also that we have seen is making sure that you have long-term contracts. Having long-term contracts, 20, 25 years, but also having incentives that they don't have to change when the government changes and there is another new government. Because sometimes when there's a new government, they change, they say, okay, what the previous government did was wrong. So this time we have to change everything. And then you find you're already engaged in long term, and definitely you are affected. You are halfway the project, you can't cancel it, but it has affected you. The other ones is also you've seen it in terms of regional projects. The railway, the regional energy, for example, in our case, you have so many of them, and others. You find that sometimes the agreement, if you don't have the regional agreement for investment and you have one contract and you are talking to 3 governments, it becomes very difficult. There is this agreement that is signed among the countries, which would give comfort to someone who is putting in the money for a long haul. The other one is also that you have seen is really how to bring in the money, but also brand it in a different way. There has to be some grants. There has to be some resources that cater for some of the guarantees from the European Union, from the World Bank, from ADB, from Asia Development Bank, and so forth. So it is how do you blend it in such a way that it's a win-win situation? Because if it becomes very expensive, even the services are going to become very expensive. So those are the things that we normally talk about. There are some, of course, what we have found that is very attractive is one, is for example, airport, because you target to the fees that are charged on every ticket, and then you establish an escrow account, and then you are guaranteed. So that way then everybody is rushing for that. For the energy, once you have structured it in such a way for energy, for water, and for others, because here you are dealing with the utility, okay? You are supplying, for example, the energy, selling to the utility, you don't have anything to do with ordinary people, because the utility in the country will be the one that is selling to individuals and dealing with that section. So here, it's a government utility that you are dealing with, so it's a guaranteed. Once you agree on the payment terms and also on making sure that the contract is in a foreign currency and this is how you'll be paid, then you are comfortable. There is no risk on that one. Then you can engage for a long haul. So that's what people are looking for, and this is what we are juggling with when you're in any country, trying to see how do you cater for their interest, but at the same time ensuring that the cost is not a burden to ordinary people as well. It's not just access. It also has to be cheap for ordinary people to be able to afford it. So that's what I would just say, just in a nutshell, that I wanted just to respond, because I need the money from the Bank of America to go to Rwanda. Thank you so much. Yeah.
Thank you. Thank you very much, Ambassador. Very enlightening and important issues you touched upon, from ranging from the importance of feasibility studies, and again, there the de-risking and the PPPs, the importance of long-term contracts, and how to guarantee income and the terms. All very, very useful. Thank you so much. And with that, I would like to turn to the other speakers and with another question. On what you see as the key steps that a government needs to follow to foster the development of a pipeline of bankable projects. Would any one of you like to speak to that question?
Roland, I would, if you like, if you
Yes,
allow
please
me.
go ahead, Marco.
So it is such a big important topic, but I think the ambassador has highlighted the key steps there. So it is about prioritizing, and it is about the feasibility and the studies that are needed in order, and the structuring that is needed around these projects, and that is what will make it more attractive. I want to give another example of the other thing is the long-term predictability of the tariffs, and that is starting to be true not only for the big, larger infrastructure projects, but also for things which are a bit more nimble, like off-grid energy access, for example. And the challenge there is a real one. So the way to get around the affordability and on one side, and the need to price some of the risks on the other must be the blended finance solutions, and so either viability gap funding or some other tools that allow to bring the return in to a point where we can bring in further capital. The other two things I want to touch on in terms of, again, good examples that I think will keep moving things. One is the work that is done in creating locally based credit enhancement facilities, so that you don't always need MEGA and guarantees from the outside. Credit enhancement can be done locally in a really interesting way. So obviously, we were involved in the example of Nigeria with setting up InfraCredit with the Nigerian Sovereign Investment Authority, where the entity would guarantee bonds and projects in the infrastructure space. And we've seen Nigerian bonds going first to 10 years, then 15, then 20 years, which was unprecedented before. So these things will help. And again, is the willingness from the government side or to allow that in a way would enable finance to go, including local finance, to go directly into infrastructure rather than, as sometimes traditionally it happens, going towards the government bond. And the local currency issue is a very, very important one. I think we need to encourage investors to start taking some local currency risk. We're doing this in a number of ways. There are a number of solutions there, the risky solutions. And I think there's a lot that there are a lot of good examples. I think that's that would be my main message. There are a lot of good examples, and it is about replicating those as far as possible, starting with that prioritization of the project and feasibility side, setting up technical units to work on PPPs in the ministries has been one example that we've seen as a key signal to the market that the government is serious about it, but also then obviously equipping the system in order for this PPP to move on.
Thank you so much, Marco, for highlighting also the local aspect there. I think it's very important, and would be very interesting to hear on another occasion about other examples you have on this. I think it would be very useful also for us to circulate among the least developed countries and others. Liz, I understand that you would like to speak to one of these questions that were just raised. I give the floor back to you.
No, thank you. I was just going to provide another example. I mean, the ambassador spoke about the different elements that have been put in place, a local development bank, sovereign wealth fund, and just to use an example of another country colleagues who are in the room from Colombia, the Colombia 4G road program, I think, is really an excellent example of pulling together all of those elements into a program that essentially sets an auction for private sector to come in and execute against the energy or infrastructure needs of a country. And so, if the framework and the development finance cushion can be harnessed together, and then identifying sites for if it's a road program or a renewable energy program, and then providing auctions that can have those contracts, those long-term contracts as the offtake with some government guarantees on it, it really does bring scale to the investments that can be made in a country. Thank you.
Thank you. Thank you very much, Liz. Jaffer, would you like to come in?
Yes. I want to just add a little bit to what the colleagues have said. I think the idea of forming a technical unit within the ministry, it does send a really strong signal to the market. And on top of that, to give it support, right? Whether it's regulatory reforms that makes PPPs move faster, because one of the biggest problem of this ability of bringing projects to the market is infrastructure projects do take a while to come to market. I mean, I live in New York City and I know how long it takes to do the new subway line. But I think what's important is for least developing countries to reduce this because of the type of infrastructure that comes in. The second part is the funding of those feasibility to do those project preparations. And I think it can take a really small amount for a local, a developing country's government to put in, say, $5 million or $3 million into a project preparation fund. And do the first 2-3 feasibility studies, because it really tells the market, and whether it's an investor or a development bank or a development agency, like, look, yes, we need support, but what is within our reach, we can do it. And that provides a goodwill for others to meet you across the table.
Can I come in?
Yes, please go ahead. Thank you, Jaffer.
I don't know if many people here have been to our countries, because there are things that we used to have that which are now gone. Initially, when when I started in the Ministry of Finance, we are having a big problem of people wanting even to finance, and we had no project. And we had to make sure that in the budget, we set aside a certain amount of money just to prepare projects. And we bring in international experts so that even the feasibility study can have credibility. These are the international companies that you all know of. So that they do it, and then from there, when anybody comes, then at least we have something that is done with credibility. But also what I was finding very difficult was for the investors to be running around from one ministry to another and being given different information. That was a problem until sometimes some of them would give up. Here I'm talking about the likes, for example, General Electric, which has been in our country, and others. Then what we decided as a government is to say, let's take it away from the ministries. We established the Rwanda Development Board as one-stop center. And then we said we are going to concentrate the capacity in that institution to be able to deal with issues of PPPs, the issues of feasibility studies, so that they are the ones handling it. The ministries can do their normal jobs of the ministries. And in the Rwanda Development Board, you can find all the capacities. From every country, you'll find experts. That's why we are concentrating the experts in all different areas. They are the ones, that's where you start, that's where you end. So it becomes a one-stop center. You don't go to see anybody. You don't go to see the Minister of Justice for any legal anything, no? You don't go to the Minister of Finance, you don't go anywhere, you just sit there and deal with the team that has been put there by the government. That's where we concentrated. And that made a huge difference in terms of actually completing the projects, but also even the investors feeling more comfortable. Well, I could tell you just, if you came to our ministry in the Ministries of Finance, you are in the middle of the meetings, and we are giving you half information here, half information there. In the Rwanda Development Board, yeah, you'll find coffee, you'll find everything, and then you'll find the people who are willing to work with you until the end. If there is anything else they need, someone has to come to Rwanda Development Board. So that changed everything that we are doing. So we found it very, very useful. So the point that you are making is very, very important. Thank you so much.
Thank you. Thank you very much, Ambassador. I would like to move to a last question to the panelists, to the experts, and then move to the room to also allow them as participants to ask questions to the four experts. And the question I'm raising now has already been touched upon, but let's see if we can get something in addition to that, what we have already heard. The question is, what is the role that the development of the domestic financial sector can play beyond financial inclusion? What instruments could be used by incipient capital markets? Who would like to start off with that one? I don't see any takers.
I can start again. I think
Marco, please go ahead.
The colleagues on the panel, I think, are all like-minded in the importance of stimulating local capital market for the simple reason that a lot of the revenues are in local. Well, first that we need to raise a lot of finance, and there are pools of finance to be unlocked. Secondly, that the finance in local currency is, at least in part, particularly appropriate for some of the projects that have revenues in local currency, and it is not just about financial inclusion. And I'll leave I'll stay again on the example, if I can, for a moment, of the credit enhancement facilities and the importance of working on those and on setting up institutions that can support issuing of bond and credit enhancement in the local market. Obviously, that goes closely with the development of local stock exchange. But I think we need to be obviously the key thing is to match the risk that different capital needs to take. For example, in terms of fiduciary risk with the stage of the projects. And the more of these instruments are in place in country, the more success we'll have in moving different pots of capital at the right time in these projects. So I'll leave others to continue to comment, but I think it's extremely important.
Thank you very much, Marco, for your views and expertise on that. Any of the three other experts who would like to talk about this?
Well, I might just
please go ahead.
Just to add, I mean, I think a lot has been said about development of local capital markets, sovereign wealth funds, et cetera, trying to make sure that that funding can remain in local currency. But one area that has been that seems to be a good avenue, but has been tricky for governments, is local pension funds and creating an asset class they can invest in for long-term infrastructure. All deposit-taking institutions, pension fiduciary institutions have some trouble with these kinds of investments because it does match their asset side, but it needs to be done in a risk-responsible way. But local pension funds and insurance funds can be good sources of that local domestic capital.
Thank you. Thank you very much, Liz. And yeah, you're very right that all of you spoke about this and responded to this question across the earlier responses that you gave. So thank you very much to those to the four experts. And I would like now to open the floor to the audience in the room and the virtual audience. I am trying here to see and collect some of the virtual questions, and I will if everybody's ready, I will read a few out and also rely on colleagues in the room if there are questions from the room. I will start with a virtual question. What is the UN or what are the UN and other agencies doing to ensure private sector has access to finance? And I think that what is meant here, the local private sector who's there on the ground. Anybody who would like to speak to that? The one raising the question also saying that support to the private sector is really critical if we really want to have an impact. Floor is open to any of the four experts. And maybe while you're thinking about it, let me then raise a second question also virtually. How can we improve financing instruments and generate investments for countries that develop their economy? And that's where now the question is in balance with nature and respect for the community of life and ancestral knowledge. So really they're talking about sustainable development across the three areas. And with that, I would like to pose those two questions to the experts and see if there are any further questions coming in the meantime. I can only see from here Marco, who was nodding. I don't know if the two experts on the ground who are present in the room also have raised their hands, and if not,
can I maybe
yes.
next for the usually there are traditional institutions that support the capital market, and when we are establishing our own capital market, we definitely got some support from DFID, the UK Development Institution, and we worked, of course, with the World Bank, which has that kind of responsibility in terms of really establishing a stock market. And we worked with other institutions for the other side on the commodities exchange. Commodities exchange is assisting our own farmers, especially for all the crops, maize, beans, and coffee, and so many others. The way they normally work is that they purchase almost everything. They give the warehousing receipt, and the receipt you can cash it in any bank. And then you can get the money ahead of time for you to plan for your next investment. It's quite different. But for the establishment of that, our own, we had to do it in such a way that we followed the normal rules. Actually, the chairperson was the managing director of the American Institute for our own, because we wanted to make sure that we do it properly and we have the expertise that is necessary. And once you do that, then there is a way of educating the whole entire population, how really to know the importance of that. And that's what I was explaining. Bring in the SMEs saying that this can also work for you. Bring in the big companies, the local companies, of course, that can work for you. And then, of course, for us on the capital market, that's where we use it and government in terms of financing our bonds, our treasury bonds, because we established the system that links the central bank to all the banking system, but also to the stock exchange. So because you have to do the clearance anyway. So once you have done that kind of system with the modern core banking system, then it becomes very clear for anybody who wants to invest. You find that most of the sovereign wealth funds, insurance companies and others, they are more interested in government treasury bonds, but also on corporate bonds because they are relatively safe. But at the same time, you find that ordinary people are also interested in shares, in stocks from other companies. And here also, we are not looking at the local kind of private sector, we are looking at the regional ones, because in our region of about 7 countries, they all know each other. And they invest in so many, all the countries, just for diversification purposes. And then you find that also most of the companies are investing the whole, in all the countries also to diversify in terms of the currencies that they have. So by having a stock exchange really has become something that's very important as an alternative for really raising resources for any kind of investment. And this has helped even for the resources of the institutional investors, as I said, if it is, for example, the unit trusts they invest in our stock market. If we find the pension funds, the insurance companies that are there that are mobilizing resources, they are also investing in the local currency because they can see the gain much easier. So that was a way of really stopping the outflow of resources to be invested outside. Thank you so much.
Thank you very much, Ambassador. And I understand that, Liz, you would also like to add to those questions?
Yeah, just to add a few comments. On the first question, the private sector, of course, is not homogeneous. And so access to financing will depend quite a bit on the size of the operation, the stability of the operation. But there are, for small businesses, for example, there are programs that the central bank can also support with local financial institutions to provide more capital to small private businesses. So that is just one mechanism that can be used. And just on the second question, which I think is very broad, and perhaps we would need a whole other hour to discuss on, but the ability to weave in, ESG, environment, social, and governance principles into finance is becoming quite mainstream now, and I think that is the mechanism as more standards are developed and more criteria are developed for finance to also remain responsible for those kinds of people and planet implications that may result in some of the economic development. Thank you.
Thank you very much, Liz. Marco, would you also like to?
Could I add just one point on the second question as well, just building on what Lisa just said? I think the awareness as an infrastructure investor of how critical the changing climate is and how critical the resilience of to climate of our assets, but also of the system around our assets. So, for example, the energy system. Or the transport systems that are around the investments that we put in place, has brought a new light and a new emphasis on nature-based solution and the interaction with nature, and what can we learn from the respect of local communities and what comes from local communities in terms of knowledge and awareness and solutions as well. And I'm thinking about the coastal communities that we've been working with, or some of the communities in water-stressed areas that we've been working with. So I think building on the overall movement on ESG, I think the awareness of climate risk and resilience then brings nature-based solution and the interaction of nature really at the center of infrastructure investment in a way that has never before.
Thank you very much, Marco.
Sorry, can I come in?
And thank you to all three respondents. We no longer have Jaffer with us. He unfortunately had to leave. So we have three experts left, and I think they answered in an excellent way the two questions that were raised virtually. And I see that in the chat, other experts are also responding to each other, so that's good. But now moving away from the virtual participants, I want to give the floor to a question from the room. I understand that a hand was raised.
Maybe before they intervene, can I just clarify one thing, if you allow?
Yes, absolutely. Please go ahead, Ambassador.
Yes, I just wanted to say, when we talk about blended finance, I just wanted to give you an example so that you understand what I'm saying. For us, when it comes to green projects, it's something very important for Rwanda. We established the Green Fund as a country and we mobilize resources for that as a nation. But at the same time, we borrowed money from the World Bank, which is, of course, for green investment. And rather than using it, we put it in the Development Bank of Rwanda. You borrow it for a long term, meaning 40 years, 10 years grace period at 0.75%. So when you put it for private investment in the green projects, like green energy and other things, then we negotiated with the Development Bank to say, you have to match this amount of money. So they did match that amount of money. Then they also mobilized other development finance institutions, especially in Europe, to also put in the resources that are meant for green investment. So now, with that kind of investment of our green fund, the resources that we borrowed that are in the development bank, and the matching from other development finance institutions, it created a big fund just to finance any green projects that we are talking about. That way, it helps to invest for long term, and also for the cost to be cheaper, because the initial money was also from the government, where we borrowed very cheaply. So that way, it created a situation whereby there are some grants, there are some loans, but also overall cost is low, and this money can be used for long-term investment. So that way, the structuring of such a financing is helpful, so that you can also target the SMEs, but also the other big projects which are critical to a country. Thank you so much.
Thank you very, very much for elaborating on that, Ambassador. I also see that in the chat, there's a discussion there going on with the African Development Bank and how to access the green funds. Chair, back to the floor. Somebody raised a hand there as well, I believe.
Absolutely. Please, the gentleman in the back, please identify yourself.
Thank you. I am Carlos from AES Colombia, and I just wanted to ask you, you've mentioned the importance of the profile of takers, and in the energy and water access projects in LDC's countries that are normally done in a rural and low-income areas, how you can manage this type of risk of off-taker, and what type of, I don't know, government policy or tools that government can give the investors to increase their confidence in this type of projects, due to the fact that off-takers are low-income population. So some thoughts that you can have in that aspect. Thank you.
Thank you very much, Carlos from Colombia. A good question there. Was there any specific expert you would like to ask this to, or to the panel as a whole, to the three of them?
Well, to the three of them, but Ms. Bronder just mentioned a project in República Dominicana, so maybe she has some knowledge in this.
Okay, thank you again. Let's start then with Liz. Liz Bronder, please go ahead.
Sure, thank you. Well, I mean, I think that regular credit processes are always used to begin with when you're assessing the off-taker and the quality of the off-taker. But blended finance is also very important. And actually, this one that we did in the Dominican Republic was together with IDB Invest. And these institutions, as we know, are very thorough in their due diligence and their monitoring processes, and also offer certain natural immunities and privileges with governments because of their nature as multilateral development banks, and so that also gives comfort. And it isn't that, and we've seen multilateral development banks be involved in supporting off-takers in other situations as well. The World Bank has given guarantees against government-owned utilities to be able to provide longer-term financing from the private sector. So those are some of the mitigating risks that can be used, as well as just collateral or other types of assets that can be used to secure financing.
Thank you very much for your response there. Any of the other two panel members who would like to come in?
Yeah, I don't know if I understood the question clearly. Let me just take two examples, one on energy and one on water. Most of the investors that we see are interested on the supply side, meaning, for example, if it is the energy plant, you are supplying electricity which goes through the national system, which has transmission lines, distribution lines, and then access. What they do is that you have the independent power producers who sell the energy to the utility, electricity utility. And then how the utility now goes to the ordinary people, the government now will depend on the government policies. For those low-income earners, they decided, for example, to subsidize. But that's the decision of the government. It's not the person who produced actually the electricity. The other ones, they have a good agreement with the government utility, and they are fine. But here, if there are any, for example, ordinary people who are low income, and they cannot afford the expensive, for example, or the cost of the energy, then that's the job of the government to subsidize. The same thing for the water. We have a project whereby 40,000 cubic meters that has been really a combination where the government will do the whole piping of the water from the plant, but the plant is constructed by private sector money who have an agreement with the water utility to make sure they can supply them water, and that's where it stops. But if there are people who cannot afford that kind of water, again, it's the duty of the government to see who can be supported so they can afford that price of the water. So there is that kind of combination, but you don't see most of the investors going on and also dealing with ordinary people, because that's another job which requires a lot of resources. And that is, of course, where the government keeps changing the policies to suit the needs of the ordinary people. Thank you.
Thank you very much, Ambassador. I hear there, again, I think a public-private partnership and the role and importance there as well to bring services to the poorer side of the population.
I wonder, Roland, if I could offer a very, very brief complementary comment on this point. Two cases in which we are taking directly risk of the off-taker as an investor. So in two LDCs, one in the case where we are in Cambodia, we're working with rural concessions for water supply. So we're co-investing with a concessionaire, and there, yes, there is an element of subsidy from the government, but there is no guarantee. So there's a subsidy on the pricing, but we're taking risk on the off-taker, and it is so we're taking risk of the client, really, client risk, and that is obviously it's a different profile. It needs a quasi-equity investment into the companies for us to make in terms of the risk. And similarly, of course, everything that is off-grid energy really takes risk on the end users directly, and because there's no utility in between. And again, we are an equity provider. We are a shareholder in a number of off-grid energy companies, and we do take that risk. It is key to work with the communities there to develop productive activities. It is really one case where you are joining with a lot of the development effectively of the local communities in terms of productive activities, because that will bring more use of energy and make the investment more viable as well. So it's about stimulating that as well.
Thank you, Marco, and good to get some real examples of your experiences and how you take on the risks. It was very interesting. Thank you for that.
So I just wanted also to say that we have some of the examples for where the private sector had gone directly to the ordinary people is where actually my colleague just mentioned, especially for the off-grid, the mini-grid that we have whereby you can produce electricity that would supply a village or two or three. But then what we have done in Rwanda is that we have also brought in the regulatory body, utility, which actually regulates the prices, to avoid any investor setting their own prices, which may be high and unaffordable. What we did is they come in and regulate, of course, the prices, say you cannot exceed this, and then the person can invest knowing that actually you've done your homework and you know exactly what you're going to get from there, but that money is paid directly by ordinary people. And in our case, we also have a system, for example, electricity. You do the cash power. You pay ahead of time. You don't pay after. Like you buy the energy that you need and you do it on the phone. So that makes it assured that whoever wants electricity, you can buy it using your own mobile phone and be able to pay for it. So much easier. So there is those kind of exceptions, especially in the remote areas where the grid cannot reach. Thank you.
Thank you, Ambassador. Excellent. Again, an example there of a real life experience, and I think the participants from Colombia got a few good feedback and examples there. So thank you for that. Before wrapping up and closing this session, that is already going over time a little bit, I want to give the floor to one last participant from the room.
Yes, Madam, in the back, please identify yourself.
Yes, good afternoon. My name is Gail Davis. I'm on the Committee for Finance for Development with NGOs that is chaired by Anita Thomas, and also Climate Finance as well group. My question to the panel of experts, all of them, is, you know, private sector is now going into stakeholdership versus shareholdership. And stakeholdership is much more attractive now because it deals with the stakeholders themselves and the people on the ground for people capital, as His Excellency had talked about before. I just would like to know your thoughts about that and how that approach can be used in financing.
Thank you. Thank you for that last question. And the floor is open to the three experts.
I can maybe start out. So
Please.
Stakeholder capitalism is becoming very important, and actually started a few years ago with the Business Council that actually our chairman and CEO, Brian Moynihan, co-founded. So that has become part of the principles of our financing for many years. And as I mentioned, the types of frameworks that financial institutions are putting in place that will look at all different types of climate and community impacts of projects that we're financing and companies that we're financing is very important. And we have climate risk departments that look specifically at those aspects of our underlying clients. But we also are seeing that the regulators are embracing this as well and setting standards that will raise the bar for everybody. And I think this is also an important aspect. In the EU, you know, the taxonomy is now required for banks, financial institutions, and companies to report against, and that is also beginning in the U.S. And other markets. So I think that, you know, in some sense, we talk about sustainable finance now, but in the future, all finance should be sustainable, and we should be looking at all of these aspects of impacts on the projects that are being financed. Thank you.
Thank you. Thank you very much, Liz. Ambassador, and then Marco, anything to add to that?
No, we're good.
You're good. Okay, thank you. Marco, closing words.
Closing words. So agree on that. I think standards are very important. Credibility of impact claims becomes even more important, both in terms of the fact that now these instruments are linked to pricing as well, and also in terms of the trust that we are creating in the system. It's really, really important that the standards go hand in hand. There are standards like the impact management principles and others, and the ones that colleagues have referred to before. I think one key element for me is how do we get, as investors and as stakeholders, better at quantifying and pricing the value of positive impacts. A lot of the assurances and the standards are still about do no harm, really, or do not significant harm. And I think you can do, especially in the interaction with climate-related investment, is really important to recognize that if you are investing in a sustainable energy production in a country with an energy gap, you should be rewarded in that way because of the stakeholder benefits that you're creating. And at the moment, we're still not there. We're still measured on carbon avoided and also on do no harm. So I think really important to measure the contribution to the SDGs and the contribution to stakeholders as part of impact accounting and investing as well.
Thank you very much, Marco. And I feel that we could continue well beyond the 1 hour allocated to us. I found it personally extremely interesting, and I want to thank all 4 experts. I understand that Ambassador Gatete and Mr. Machano already left, and therefore I'm left here to personally thank Liz Bronder and Marco Serena for an excellent discussion, and also thanking the audience. And with that, would like to invite you all to please join us again tomorrow in person in conference room 8 and virtually using the same connection details as today. And that will be tomorrow as of 9 a.m. New York time. Tomorrow the fair will resume with the government of Eswatini, which will showcase investment opportunities that advance the 2030 agenda for sustainable development. We look forward to welcoming you all there again. And once again, as the moderator, I thank everybody very much for this very interesting session. And with that, I would like to close this session. Thank you.
Thank you so much. As chair here in the room, I want to thank Liz Bronder for staying here with us, and you for moderating this session, Roland. That was really great, and everybody in the room, and reiterate the invitation to see you again tomorrow at 9. We will have exciting presentations, and we also have a very exciting session with Colombia at 5 p.m. that I hope many of you will join. And also, we will share the decks of the investment opportunities, and we really look forward to follow up. And the UN is here to support any kind of networking that you may want to do for the success of the projects and the SDGs. Thank you so much. And thank you so much, BCSS and all colleagues, for all the preparations for today.